In this reading, we're going to talk about who are the investors in a company, whether there are those that are investing in the shares of the company, which is their shareholders, which are the owners of the company, or is it those investors that are giving loans to the company. This is debt and this is equity. Then we are going to talk about who are the other stakeholders. It's not only the investors that are stakeholders in the company. Of course, shareholders are probably the most important stakeholder in a company. But there are others, such as the providers of debt, such as the employees of a company, the management of a company, the government which gets tax, the suppliers which depend on the company, the customers of the company. They are all stakeholders in this company. And how do you balance between their needs? So all of them have certain rights, all of them have certain duties. How does the board of directors, which governs this corporation, so from a perspective of corporate governance, how do the board of directors balance between the rights of all these different stakeholders? And then finally, we will talk about the most important stakeholder that has been historically underweighted or overlooked is the environment, right? The society. And then, of course, the governance factors that we already talked about, that balancing between all the different stakeholders, which includes society, right? And most importantly, we're going to be talking about the environment, especially these days, because climate change is becoming a more serious concern than it has been previously. So, as discussed, what are we going to talk about in this learning module? First, we'll talk about the different type of securities that are issued by corporations, such as bonds for debt and such as stocks for equity. What are the differences between these two types of equities and debt securities in terms of their risk, in terms of their return? So, in terms of their risk return profile, what are the conflicts of interest between debt and equity holders? Because debt holders are obviously not going to share in the profit. They only get a fixed payment. So they don't want the company to take too much risk. Equity holders obviously get a share in the profit. So they want the company to take more risk so they can have more profit. So there is a conflict between these two. So after we talk about the two main stakeholders, we are going to talk about the other stakeholders, such as the employees, the management, the society at large, your suppliers, your customers. So they are all stakeholders in the company, and what are their interests. And then finally, we will close the learning module with a discussion about the environmental, social, and governance factors. So what is a company? A company obviously invests in certain assets. And where does it get the money to buy these assets? It either gets it from people or institutions that give it a loan, so that is called debt, or it is providers of equity, right, that buy their shares, and it uses this money to invest in certain assets. Let's say a company is starting off with $10 million equity, $10 million in a loan, and it invests these $20 million in a certain investment that, let's say, pays 10% return on investment per year. Now the loan they have taken, maybe that loan is at a fixed rate of 5%. So that means that they only have to pay, which is 5% of 10 million is 0.5 million. So their interest is going to be 0.5 million, right? What is the income that they will have? 10% of the 20 million. So they earned, their income is going to be 2 million, which is 10% of 20 million. And then what they will have left, the net profit, is going to be 1.5 million. Now 1.5 million on this equity investment of 10 million is 15%. So as you can see that it is attractive for this company to get debt financing because it is at a lower rate, lower than what they are earning on the assets. So even though on their assets they are only earning 10%, but for the original investors, the equity investors, the return that they are able to make on their investment is 15%. And clearly 15 is greater than 10. And why they are able to do this is because they are leveraging the business. They are leveraging the business by taking debt, which is at a lower rate than what they are earning on their assets. That's why companies are interested in getting money from debt providers as well. But this is not so simple because this 5%, this is a fixed rate. This is a fixed rate. Let's say if the return is not there, if the profit is not there, and then let's take that scenario. Let's say the profit is not there and there is 0% return on these assets. So your income is 0, right? So your profit is actually going to be minus 0.5 million because you still have to pay the debt providers. This is a fixed payment. This is what we call a contractual obligation. As per the contract, you have to pay them. So the return on your equity is actually going to be a negative 5%. So that's the risk the equity holders are taking. In a good year, they are making 15%. In a bad year, they're making negative 5%. So this is the bigger picture. And let's go through the details together now. So first of all, debt is a fixed payment. It is a contractual obligation. Whether the company has profit or loss, it doesn't matter. You still have to pay interest on the debt, right? It is obligated. The company is obligated to pay the promised interest and the principal payment. So whatever repayment has to be done of that 10 million loan, not only the 5% interest has to be paid, but even in some years, the original principal, which is this 10 million, has to be paid back, depending on whatever is the contractual obligation in terms of when you have agreed to pay back the principal, right? How many years or months loan was it? Compared to that, equity is not a contractual obligation, right? The company doesn't have to pay the equity holders a dividend. It's not a contractual obligation. The company will pay it if they want to, if the board of directors decide that they can and they want to. Otherwise, they don't have to. And if, let's say, the assets of the company are originally worth 20 million, the debt is 10 and the equity is 10, and let's say there is a big loss over here and this gets wiped out to 5 million. Who's going to get this 5 million? Obviously all that money is going to go to your debt providers. Only if something is left will it come to the equity providers. So the debt providers have a prior claim, a senior claim to the company's cash flows and assets. Whatever money the company gets, first you have to pay the interest of the debt holders. You have to then obviously make sure their principal is also paid back, and whatever is left, the residual claim on the company's net assets, which is after adjusting for the liabilities, is what the equity holders can have. Now, another benefit of the debt payments is that, let's say this is my sales and this is my cost of sales, right? And this is my gross profit, and then I've got my selling, general and administrative expenses, and I make a operating profit of, so let's say my sales is 100 million, cost of goods sold or cost of sales 50 million, gross profit 50 million, selling, general and administrative expenses 30 million. So my operating profit is 20 million. Now, this is, by the way, also called earning before interest and tax, EBIT. And you will learn about this more in your financial statement analysis, about this whole income statement structure. But earning before interest and tax, what I want to emphasize on is the word interest, because until your interest is not deducted, let's say your interest on the debt is 10 million or 5 million, whatever, right? 5 million or 0.5 million, as we discussed in the previous example. Whatever it is, the point is the profit before tax cannot be calculated until you subtract your interest. And then whatever is your tax, let's say it is 30%, it will be applied to this profit before tax. So interest, actually, the higher the interest, the lower your profit before tax, and the lower your profit before tax, the lower the tax you pay, because tax is a percentage of the profit before tax. And then this tax saving, this saving in tax is also something that you take into account when you calculate the cost of your debt. Because at the outset, what you are seeing is that, okay, I'm getting debt, I'm getting equity as a company, right? And equity investors in equity are probably expecting something like a 15% return, and the providers of debt are only expecting a 5% return. But on this 5%, if you're paying interest, if you're paying a certain interest, it will reduce your profit before tax, which means it will reduce the tax you have to pay, and that will further reduce this 5%. How? Let's say 30% is the tax, and this interest amount of 0.5 million that you paid, right, it will reduce your profit, which means you didn't have to pay tax on this 0.5. So 30% of 0.5 is 0.15. Now this 0.15, on, if you divide it on a base of the 10 million debt financing, what you get is 0.015, or in multiplied by 100, that is 1.5%. This is 1.5%. So this 5% of debt is actually not 5%. After adjusting for the tax benefit, it becomes 3.5%. And this is a very important point, that because of the interest payment, your profit before tax amount becomes lower, and therefore your tax as a percentage is calculated on this profit before tax, and the tax amount is lower. And how much is the saving of tax? The tax amount multiplied by the interest amount, and that, if you see as a percentage of the total debt, it's coming to 1.5%. So that means your debt cost is not 5%, it is 5 minus 1.5, which is 3.5%. If you compare that to the 15% of equity, then the debt looks really cheap. Because to start with, it is having a lower rate of 5%, and then further, after adjusting for the tax benefit, it becomes even lower. So that's why companies find getting debt financing very attractive, because it's just cheaper. Whereas equity payments obviously are not tax deductible. Whatever dividends you pay are not going to impact your profit before tax, because only after your tax is deducted, then from the net profit you can pay dividends, right? But that is something that is going to be after tax, so it doesn't affect your tax. So equity does not get the benefit of tax saving, but debt does. So that is why companies will be very much interested in getting debt financing, because it is cheaper to start with. And why is it cheaper? Because they are taking less risk. The providers of debt are taking less risk. They are going to get their money back first before the equity holders get back, and they're getting a fixed rate. So that's why they're happy with a lower rate. And the company, if it can afford to take that risk, that they know their cash flows are very, very stable, then they can afford to get into this contractual agreement where they are contractually agreeing to pay a fixed rate, right? And the benefit of that is that they get a lower cost of capital. Now, you might be thinking, then why would anybody want to go for equity, right? Why would anybody want to go for equity? The reason is, this company, if it gets 100% financing from debt and 0% financing from equity, what happens is if there is a loss, right, then who is going to take that loss? Because the debt holders are not going to take the loss. They want their money back with interest, right? So that is why you need to have some equity in the business, even though it might be looking very expensive to you, right? But you have to have a certain amount of equity in the business to absorb losses, because debt is not going to absorb losses, or debt, well, contractually is not going to absorb losses. But if there is no equity, then of course the hit will go to the debt providers, and therefore the debt providers are not going to be willing to give you debt if there is no equity in the company. So there has to be a certain amount of equity in the company, and whoever are the providers of debt, they will always be looking at this debt to equity ratio, that how much is your equity versus the debt, and they will stop providing you loans if they feel the equity is very small. So equity provides a more permanent source of capital, because the debt not only requires the interest, but also the repayment has to be done of the principal. So it's not like a permanent loan that is there. You take a loan, and then not only do you have to pay interest on it, but you have to obviously repay the principal. Maybe it will be for 10 years, but nevertheless, eventually you have to pay back the principal. But with equity, it is an infinite life. There is no finite term, right? So it's attractive from the company's perspective. Why would an investor in equity be then investing in this company's equity if they are going to be taking the hit of the losses? Well, we already discussed that they earn a higher rate if the company is in profit. Number one. Number two, they also get to sit on the board, right? Who are these guys sitting on the board? They are basically the board of directors, are appointed by the shareholders, and the shareholders vote them in. They have voting rights. Debt holders don't have voting rights. But debt is a cheaper source of capital, and it has a finite term and no voting rights. Now we're going to talk about debt and equity from both the investor's perspective and the issuer or the company's perspective. Now, from the investor's perspective, obviously equity is riskier. Debt is a safer option. Debt holders receive predictable, well, I would say rather fixed, but there is still a chance that the company might go bankrupt. So it's not 100% guaranteed, but it is very, very much predictable, much safer than equity. Whereas obviously payments to shareholders are not guaranteed. They are at the discretion of the company or the discretion of the board of directors, to be specific. However, equity holders are, of course, having an unlimited profitability. So let's say this is the amount of profit or loss that your equity holders can have, and let's say this is $10 million, which is the maximum loss your equity holders can have. And on this axis, let's say this is the assets of a company. Now, if the assets of the company are at 20 million, right? If the assets of the company are at $20 million, at that time your equity holders are break even. But if the assets fall below 20 million, obviously the loss is going to go to the equity holder. So this is the equity holders P&L. If the assets of the company fall in value from 20 million to, let's say, 10 million, if they fall down to 10 million, the loss of your equity holders will be 10 million, because this remaining 10 million belongs to the debt providers, right? Secondly, if the assets start going up, no matter how much they go up, they could go up to infinity, and the profit of your equity holders can be infinity. There is no upside limit. They have an unlimited upside, right? And that's how you see all this wealth has been created. Elon Musk, Bill Gates, the owner of Amazon, Jeff Bezos, right? How have they made all this money? Because they have equity in companies, and the companies have done very well. So the assets of the companies have grown, and therefore their value has grown. Their investment value has grown. So equity obviously has its charm. But if it was the other way around, that the assets came down, then of course the debt holders would be paid first. So if once after the other stakeholders have been paid, then only the unlimited upside is there. And that is only interesting if your assets are going up. If they are going down, of course, then that is going to be a loss. So yeah, this is a high risk, high return investment. And that is why equity holders have an interest in the ongoing maximization of the company's value. They want the company to grow as much as possible so that their wealth, the shareholders' wealth, grows. On the other hand, if a company becomes very, very profitable, it doesn't matter to the debt holders because they're still going to get their fixed interest, right? Their interest amount is fixed. It's not like they are having an unlimited upside. For them, it's not like this, that once, let's say this is 20 million and this is 10 million and this is zero, right? The assets of the company. And if we talk about the P&L of the debt providers, first of all, they will have a fixed P&L of, let's say, 10 million investment plus the 5% interest that they have. So whatever that amount is, that is their profit and loss. But once the value of the company starts coming down, and even when it comes from 20 to 10, the debt holders don't lose anything. But once it goes below 10, because between 20 and 10, it is the equity holders who will be losing their money. But once it starts going below 10, then the debt holders, they start losing their money. And they will go into negative territory. They will lose all their money. And they will have a loss of 10 million. So what is important to appreciate over here is that both of them have a similar downside, that both can lose their original investment, but the no unlimited upside, right? They only have a limited upside, which is just that 5% interest. Their maximum return is capped. So they want to play it safe, and this is where the conflict of interest is going to come in between the debt and equity providers, that the debt providers will be saying, hey, don't take too much risk, we want to play it safe, we just want our 5% interest back and our principal back. So please just focus on timely repayment of our money and don't take too much risk, because you as the equity holders will want to take so much risk so that you can have so much profit. But they are not going to get any share of that profit since their return is fixed, their return is capped. So they will not want you to take too much risk. Whereas if they lose, they're going to lose the same amount of money that you can lose in terms of a percentage, that you can lose all your money, they can lose all their money. But you have so much to gain and they have only a limited fixed amount to gain. So let's summarize it over here. The tenure of your equity is indefinite. It can be infinity. It is infinity. And your term is debt can be fixed, maybe 1 year, maybe 5 years, 10 years, 30 years, whatever, but it is a fixed term. Return potential for equity is unlimited, whereas for debt is capped. Maximum loss for both is the same, that is, you can lose up to your initial investment. But why is debt more attractive? Why, despite the fact that the loss is the same for both, but the returns are not unlimited here, they're capped here, why people will still want to go for debt is that the risk is lower compared to equity. Equity, the risk is higher. Because if there is a loss, first you have to pay back your debt, and then whatever is left will be paid to the equity holders, right? And what are their desired outcomes? Of course, debt holders want their money back on time with interest, whereas equity holders want to maximize the firm value. Now let's talk about the company perspective or the issuer perspective. Why we are calling them an issuer? Because they are issuing these securities, stocks and bonds. So what is the company's perspective? As a company, would you rather issue equity or debt? Well, it depends. If you have very stable cash flows and you can afford to take that risk of taking on debt, because debt, you have to pay. It's a contractual payment. It's a contractual obligation. It's not an option for you. Because if you're unable to pay, then you will have to declare bankruptcy and liquidate your assets. You'll have to sell your assets to then settle their loan. So you have to be very careful when you're taking on a loan that can you really generate enough cash flow from whatever assets that you are buying that you are able to service this debt. It is cheaper, and that is why it is attractive, because the rate is going to be much lower than what the equity holders will expect from you. And equity holders, you have to share your profit with them. You don't have to share your profit with the debt holders. Debt holders just want that fixed return. But then if you are not able to pay it, then they can force you to liquidate. So although riskier, the cost of debt is lower than equity. This is because the returns are capped and the risk is also low because they get the money back first, then equity holders get it. So if you are a company with stable, predictable cash flows, then okay, go for debt. But if not, then you're better off going for equity. Otherwise, the debt might end up bankrupting you. However, if you do go for equity, then you will have to share the profit with them, which means it will dilute your upside, right? It will dilute your upside. So let's say you have a company, you just started it, now you want to expand. Would you rather take money from debt holders? Like, would you rather take loan from a bank, or would you rather get a partner in the business? Now, if you get a partner in the business, that partner is going to take a share of the profit from you, which means it will dilute or make your upside little bit less interesting for you. On the other hand, you might not be having predictable cash flows, so it would be too risky for you to take on debt, because if you're unable to pay them on time, unable to service that debt, unable to pay the interest on time, then you might go bankrupt. So that's why it might be better to let your upside get diluted and still go for equity. Sometimes you don't even have a choice. Early stage companies, their cash flows are so unpredictable. They've just been started. Startups, venture capital startups, very, very small companies. They don't have any history, so their cash flows are unpredictable, and the bank is not going to give them a loan. Debt providers are not going to buy their debt securities, so they have no option but to raise equity. In the event of a default, what happens? Let's say you are unable to pay the interest on time. Well, the first thing is you can try and negotiate the payment date with your debt holders, that can I have some more time. And let's say they give you more time, but you are unable to still pay their interest and their principal back, then you might have to sell the assets of your company. Whatever money will be generated by selling those assets, that will be first used to pay off your debt holders, your bond holders, your bank loan, right? And then whatever is left will be for the equity holders. And let's say the debt holders say, hey, stop, don't sell the assets. We are going to take over the company. So let's say this is your company, and you have your equity, and you have your debt, and you have your assets, right? 10 million debt, 10 million equity, and 20 million assets. Let's say that gets wiped out to 9 million. Now your equity gets completely wiped out, and there were some people who were the equity holders who were sitting on the board of directors, right? These guys were the board of directors, but now they have been wiped out. So one option is you sell these assets of 9 million and you pay back the 10 million of the debt, but the debt holder says no, don't sell these assets. You guys just get out of the board, right? You get out of the board and you just get out of this whole company, because you are wiped out now. We are going to come in and we are going to now manage this company. So they take ownership of the company, they convert their debt to equity. So I've seen that happen, right? So what happens is that the existing shareholders get wiped out and the bond holders become the new shareholders, and they reorganize the company, and then they try and fix it and take it back to 20 million. So they not only save their original investment, but they get a profit on it. So let's summarize the issuer perspective now. The cost of equity is obviously higher. They expect a higher return because they're taking a higher risk, but debt obviously is lower, and even after adjusting for tax it becomes even lower. So the cost is definitely lower for debt. From the company's perspective, this is more attractive. What is more attractive? Debt is more attractive because it is cheaper, right? But you really have to have stable cash flows so that you can pay the interest on time. So this will be preferred. The attractiveness is there, but it will be preferred when you have stable cash flows. If you don't, then if your cash flows are absent or unpredictable, then obviously you're better off going for equity. But do keep that in mind that you will have to share your profit with them, and that will dilute your share of the profit. And then, of course, from a company's perspective, this is the company's perspective, which is more risky. This is the company's perspective, right? The issuer's perspective, which is more risky. Obviously, debt is more risky. Now, debt is safer from the debt investor's perspective, but looking at it from the issuer's perspective or the company's perspective, this is more risky, because here you are taking the risk of bankruptcy as a company. If you are unable to pay on time, then you will have to liquidate your assets, right? Whereas equity is low risk. So even though you are diluting your profit, but as far as risk is concerned, your risk is lower, because the equity holders cannot force you to sell your assets, to liquidate your assets. And last point in this section is that there is a conflict of interest between debt holders and equity holders, and that is what we have already discussed, that the debt holders want to play it safe. They like less risk because they just want that stable, predictable cash flow, right? Their upside is limited. So why will they want to take risks? So they just want to play it safe. Whereas the equity holders obviously have a unlimited upside. So they will obviously want to take more risk. So they will look for riskier projects which have a higher return potential. Alright, we're going to stop this video here, and in the next one we're going to take it up with who are the different stakeholders in a corporation.